All right, thank you for tuning in to Chuk Woo's channel. I am Woo. Please like, share, and subscribe. Today I'm going to be talking about investing. I'll explain what financial investing is. I'll give you a few common terms. I'll talk at a high level about some simple types of investments. And in the second part of this video, which I'll upload, we'll talk about the different types of investing risk, some basic investment strategies, and what you should know and do before you start to invest, okay? I'm going to keep this very simple, very straightforward. Walk with me. Now, what is investing? It's very simple. Investing is when you use your money to make more money. That's it. Why do people invest? Many different reasons. If you're like me, you're feeling the pinch of inflation. You're starting to understand that just having one source of income, whether it's your job, whether it's a business you own, is not going to be enough. So people invest to have another source of income. They invest to beat inflation, which I'll explain in a moment. And they invest to grow their wealth. Everyone wants to make more money. Another strategy besides your paycheck is to invest. Now, what do people invest in? Very simple again. People invest in assets. An asset, as a simple explanation, is anything that you own that you expect to earn you money. Stocks and bonds. I'll talk about stocks and bonds in a second. Real estate, even rare collectibles, Pokemon cards, baseball cards. If you own it and you believe you can sell it and make money from it, it is an asset, okay? So now you know what investing is, why people invest, and what they invest in. Let's talk about some very simple terms here, or very common terms you will hear when you're discussing investing. The first is the stock market. People talk about the stock market all the time. What is it? It's just a bunch of exchanges like the New York Stock Exchange, NASDAQ, where investors like you and me buy and sell shares in publicly traded companies, okay? Publicly traded means like it's an Apple, it's a Home Depot. They issue shares that anyone can buy on the stock market. Privately held means it's a small or medium-sized or even a large company where only the owners and other insiders can actually invest in the company. It's not publicly traded. It's not listed on the stock market, okay? Another term you hear is compound interest. Compound interest is basically when you use your money to make more money. And that money that you made also makes more money, okay? That's the very simple explanation of compound interest. I'll give you an example. Let's say you open up a high interest savings account and it pays you 10% a year. You're gonna have a very hard time finding an account that pays 10% a year these days, but just for simple math, you open up a high interest savings account, it pays you 10% per year, you invest $100 in it, you don't invest anymore. How much do you have at the end of year one? It's simple, you have 10% of your investment or your deposit of 100 bucks. That gives you interest payment of 10 bucks. Now you have $110 in the account. How much do you have at the end of year two? Same math. You start with the 110, 10% of that gets you an additional $11. At the end of year two, you add that $11 to what you started with at the end of year one, which was 110. Now you have 121. So that's the effect. Think about it simply. It doesn't just give you 10% of your initial investment, 10 bucks, 10 bucks, 10 bucks. It's 10 bucks added to the original, 10% of that added to that, 10% of that. That's the effect of compounding interest. It basically snowballs, okay? When your money earns money, the money that you earn plus your original money makes more money. That's compound interest. Now, diversification, another term that you'll hear commonly used in investing. Very simple explanation. It's when you spread your money out, the money that you invest across different types of assets. Maybe you invest in some stocks, maybe you invest in some bonds, maybe you invest in some real estate. The purpose of diversification is to make sure that your money isn't tied up in one single asset with the ultimate goal of reducing your risk. What that means simply is you don't want all your money tied up in one stock. If that stock tanks, your money's gone. You want to spread the risk out, diversify in different areas. It's part of a healthy portfolio, and a portfolio is just everything that you invest in, okay? Inflation, I touched on inflation earlier. Inflation, very simply, it's the slow rise in the price that you pay for goods and services. Okay? It means that your money, the same amount of money that you have, can buy less than it used to. I'll give you an example. You go to the grocery store, we're all starting to feel the pinch of rising grocery prices. Last year, you spent $100. Let's say you were able to get a week's worth of groceries for you and your family for $100. With inflation, the slow rise in the cost of all the goods, milk, cheese, bread, eggs, chicken, that same $100, for example, now only gets you 5 days worth of food for your family. Basically, that means the same amount of money gets you less. That's what inflation is. It's slow, but it's a monster. It creeps up on you. And then the final term I'll discuss here is something you'll hear. It's called leverage. Again, these are just all different terms. Leverage basically means you borrow money to invest, borrow money that you don't have. Let's say you have $1,000, but you want to buy $2,000 worth of Apple stock. You can go to your cousin, they give you $1,000. You can go to the bank, they give you $1,000. If you're credit worthy, now you have $2,000. It's basically just investing with money that you didn't have, money that you borrowed. It can be very risky. It can be beneficial if you, let's say you take out a loan, you use it to invest in a company, and the company does well. But remember, the flip side is true. You take out a loan, you use it to invest in a company, the company tanks, now you're losing money. And remember, you still owe the full amount that you borrow. That's why leverage can be very dangerous. Now, let's talk about a few different types of investments. These are not all the investments, just a few types. The most common type of investing is to invest in stocks. These are shares of companies. You buy, you become a partial owner. You buy 10 shares of Apple on the stock exchange, you're a partial owner of Apple. 10 shares of Home Depot, you're a partial owner of Home Depot. Why people like stocks? It's easy to do. It's easy to buy and sell. They're liquid, meaning you can immediately sell or buy. It's very fast. You don't have to wait for 2 weeks to get your money, like buying a piece of real estate. And it allows people to invest in companies that they know. It's transparent. You can check the price every day or 100 times a day if you're like me. So that's why people like stocks. It's the most common type of investment strategy. Another type of investing is bonds. Bonds are a bit different from stocks. Bonds are, think of them as debt that are issued by companies and governments. I'll give you a very simple explanation. So think of a bond. A company wants to raise money. They issue bond. It's basically an IOU. What you do as a bond investor, in this example, you gave the company, you bought $1,000 worth of bonds. You gave them $1,000 to do what they needed to do. What do you as a bond investor get? And you can check out my video on bonds. You get two things. You get the interest rate, which is called the coupon rate on the bond. Let's say it's 10%. And you get your initial payment back. So you bought a $1,000 bond. It pays 10% in this example. That means every year you'll make $100. When the bond matures at the expiry date, it's called the maturity date, you not only have all the interest payments that they paid you, they usually pay you 2 times a year, you also get your initial investment back of $1,000. That's bonds. You get your initial investment back and you earn interest. It's called a debt. Now, cash equivalent. Cash equivalent are things like money market accounts, certificate of deposits, like you go into a bank, you deposit $1,000 in a CD, it's supposed to pay you X% interest over the life of the CD. People like cash equivalents because they're liquid. You can always take your money out in most cases very quickly, and they're very low risk. You're not going to lose money, right? If they guarantee you 3%, 5% on a CD, you will get that money because it's a contract. But that also means that you're not going to make a whole lot of money. In the stock market, you can in any given year make 20%, 30% in some years. You're not going to get that with things like CDs and high interest savings account, but they are safe. They protect you from loss. Another type of investment is real estate. Real estate is basically you go out and you buy a house. 2 things can happen. The house appreciates, meaning it's worth more in the future than what you paid for it, so you can sell it and get a profit. Or another way is you can buy a multi-family home or even a single family home and you can rent it out to tenants. They pay you rent. You use some of that rent to pay the mortgage. And if there's excess, you keep that. That's your profit. Okay. And then there are other types of investments. You have precious metals, gold and silver, which have been very hot for the last couple of years. You have cryptocurrency, which some people are into, Bitcoin, Ethereum, etc. So this isn't every type of investment. These are just the common ones, right? Stock, bonds, cash equivalents, real estate, precious metals, crypto. Now, that's today's video. I told you what investing is, what some common terms are, some different types of investments. In the next video, I'll discuss the risks that come with investing. It's not risk-free. You can and will lose money. We'll talk about some investment strategies, and finally, we'll talk about things you should know and do, again, before you start to invest. I hope this was very straightforward. I hope this was valuable. Please like, share, and subscribe. Thank you very much for tuning in, and I'll talk to you in the next video. Take care.